Okay, Kevin, can you see the screen?
Yep, the market slides are showing up nice.
Perfect. So in regards to a brief market outlook here, we want to talk about the strong start that we've had to 2023, and these slides are going to be going through the first half of the year. So all the numbers are through the end of June. Looking at number 2 there, the Fed is likely to keep interest rates high. In fact, there still might be another rate hike or two, but we are at least done with all of the big interest rate increases that we saw last year. So that's good for the economy. And then number 3 is the slowing growth that we're seeing, but no recession yet. We'll see what type of soft landing or hopefully not a hard landing we will have in the coming months. But definitely growth is starting to slow based on some economic numbers that are coming out. So if you look at the returns, it's kind of a tale of 2 years. 2022 is in the orange/red color there, and 2023 is in yellow. So looking at the U.S. stocks on the left-hand part of that slide, down 18% last year, 7th worst year in U.S. stock history. And then this year we had a very nice return of 17.5%. International stocks were down about 15% last year, up about 13% this year. And then bonds had the worst year in bond history last year, down 13%. And typically bonds will do well when stocks don't do well, but last year was one of the 4 times in history where stocks and bonds went down in the same calendar year. So bonds really had a bad year last year, down 13. This year they're up about 2%. And then you can see cash as a conservative asset class there on the right. But I wanted to spend a moment talking about this year's stock market. So the yellow, the U.S. stock market up 17.5%. It's a little bit deceiving in the sense that where are those returns coming from? If you look at the 7 largest or 7 particular stocks in the S&P 500, for instance, you can see those on the right side here: Nvidia, Facebook, which is Meta, Tesla, Amazon, Apple, Microsoft, and Google. These numbers are the rate of return that those individual stocks have had through the first half of this year. So Nvidia is up 190%, Facebook's up 139%, and so on and so forth. These stocks that I just named off here are making up 70% of the return of the S&P 500. So the other 493 stocks in the index are only accounting for 30% of the return. So really, this stock market has been much more tech-driven, or more specifically, as I would say, more artificial intelligence-driven. That's kind of been the buzzword this year. Looking at the stocks that have done well, it has to do with that artificial intelligence word. And this is just an interesting slide I put together in terms of the months it took to reach 100 million users. If you look at some of these things we've probably all heard of, Uber took 70 months to reach 100 million users, Spotify 55, Instagram, TikTok, and then you look at ChatGPT, which is that search engine, that artificial intelligence search engine, took 2 months to reach 100 million users. So people are definitely looking at this as a market changer. And it will really affect every industry that we come across. This is just some industries there like marketing, healthcare, education, and consumer care. They're already looking at the tectonic shifts that are happening because of artificial intelligence. So the market's kind of propped up by those stocks that have that tech side, artificial intelligence side of their business. But the market in general more is looking at whether we're going to tame inflation and go into a soft landing in terms of versus a hard landing recession. So more to come on that as we go through the months ahead. I'm going to turn over to Kevin to cover these last few slides. So Kevin.
All right, appreciate that, John. I appreciate the nice market intro there. Now, I'm going to touch on 3 slides on my part. First, I'll touch on the current slide on inflation, and then I'll go on to a slide on the Federal Reserve rate on the second slide, and then the last one will be on economic data. So to start with the first one, after hitting our peak of 9.1% in year-over-year inflation back in June of 2022, our inflation rate has been subsiding overall. More recently, our June of 2023 year-over-year inflation rate dropped down to 3%, with, again, the Federal Reserve target being slightly lower at 2%. Now, with the current inflation rate approaching the Federal Reserve target rate, most likely interest rates will stay put, or if anything, increase minimally until that 2% target is hit. Also, as a result of the 11 Fed fund rate increases over the past almost year and a half, many key inflation categories have been moderating. So core goods have come down to 1.4%, food is down to 5.8%, shelter comes in at 7.8%. Again, as part of shelter, we need to remember that due to the year-long leases, inflation that's baked into the shelter, it takes a little bit longer to sort of flow through that number. And then lastly, energy, as you can see, dropped by 16.5% year over year. So that's certainly playing a big role in pulling down that overall inflation number. Okay, so to help combat inflation, the Federal Reserve has raised rates faster than they have in the past, over the last 30 years. They've increased rates by 5.25% in under a year and a half. Now, this slide shows the last 3 times the Fed has been in an interest rate hiking cycle, with the current rate hike cycle increasing rates the most this current time. Currently, the Fed projects that the federal funds rate will be slightly higher by year end, then dropping down slightly as we get into the first and the second quarters of next year. Okay, on to economic data. So when we think about economic indicators, there's a few metrics for us that come to mind. First, we have the unemployment rate, which is currently strong at 3.5%, and that's below the 4.2% threshold where some concern could begin. So that's below that. And then secondly, we have bank lending standards, which basically means is it becoming easier or harder to get loans. Now, the current level reported is 46%, which is definitely above the 20% concern level. Then we have thirdly, we look at industrial production. And if this indicator is less than 5%, there may be some cause for concern, and it currently comes in at 0.2. Fourth, we have small business optimism, and that indicates how optimistic or pessimistic business owners are. Now, the level being reported is at 89.4%, and that's just below the 92% that may cause concern. So it's pretty much right at that level there. And then lastly, we look at personal income, and that does help us measure a consumer's balance sheet. So the current income level is 1.6%, which really isn't concerning since it is greater than the 0% that we look for. So all that being said, it's looking more and more like we have a shallow recession, if a recession at all. So I'd like to transition now onto our featured topic of the day, which is our tax briefing, manage your tax bill for 2023 and beyond. So now, even though John and I are not authorized to give tax advice as we help our clients through the financial planning process, we certainly play a role in helping our clients navigate the ins and outs of the tax landscape. So I'll give John a minute to pull up that slide deck.
1 second, Kevin.
Yeah, take a look at that. All right, that looks great, John.
Great.
All right, so I'll leave this off here. So today we're talking about managing your tax bill for 2023 and beyond. So we're going to explore some of the major changes for 2023 and also some various strategies for managing through them. So I'm sure that when Benjamin Franklin famously said, "In this world, nothing can be said to be certain except death and taxes," even he never envisioned how complicated it would become. So in light of the somewhat recent, and this was from back in 2017, the last tax law change on the tax side, tax reform, we want to cover some of the biggest changes that were introduced. Now, we hope you find this information useful. We'd also be happy to review anything you see today with us in more detail at a later time as well. Okay, so John, if you want to go up one slide, that would be great. There we go. Thank you. All right, so today we're going to review the new 2023 tax rates and brackets, as well as some of the other changes to the tax rules. We're also going to review a few additional taxes on high income earners. We will then discuss a few strategies for managing your taxes, and we'll provide a few ideas for managing your tax bill. So one of the first things we need to manage is your tax rate. Rates and brackets have changed for 2023. Now, the marginal tax rate is a percentage of income that is paid to the government for each tax bracket in which you qualify. So in essence, it's the percentage taken from your next dollar of taxable income. So for example, in the case of, and then we'll use John Doe, a single man with a taxable income of $250,000, his first $11,000 in income will be taxed at the marginal tax rate of 10%. And then the next $33,725. And again, this is calculated taking the amount of the income qualifying for the next marginal bracket. So you take that 44,725 minus the 11,000. So that additional amount of income would be then taxed at 12%. So the next marginal tax rate, and so on and so forth, up until all of John's income is taxed. So you may hear people talk about an effective tax rate. Now, the effective tax rate will be the percentage of all your pre-tax income that is paid to the government. So because of the deductions and exemptions and our use of the marginal tax code, this number will always be lower than your actual marginal tax rate. If this system of calculating income wasn't complicated enough, add in all the additional taxes on high income earners, and things start really to get complicated. Particularly for high income earners, the tax bill becomes even trickier as they become subject to all sorts of super taxes, shadow taxes, and surtaxes. Well, let's take a look at some of those taxes. All right, so the first tax on is investment income. And that's one that we're all pretty familiar with. That's on capital gains taxes and the tax on dividends. So capital gains are a gain on anything, most commonly on common stocks that you sell. So there is a distinction between short-term capital gains, which are gains on any asset you have held for less than a year, and on long-term capital gains, which are gains on assets that you've held for longer than 1 year. Also, short-term capital gains are taxed at your ordinary income tax rate, while long-term capital gains are taxed at a preferential rate of either 0%, 15%, or 20%. And that's all dependent on your tax bracket. So generally, there are two strategies to choose from in any given year. So you either want to minimize the income you report to the government in order to reduce your tax bill, or in some cases, you want to accelerate your income into a year. And that's especially true if it's a low income year and you anticipate higher tax rates in the future. While we may face higher tax rates in the future for most of us, we can expect the current tax rates to stay the same for the next year. But what about your income? If you think your income will stay about the same, most likely you'll want to minimize your tax bill for 2023. However, if you think your income will rise next year, maybe you anticipate the sale of a major asset in 2024, for instance, you may want to push some of that income into this year while you're in a lower bracket. This is called bracket management. And with the onset of all these new taxes, bracket management is going to become more important each year. Some years you may be making more money and want to push income into low earning years and vice versa. But the game is to really land in the lowest tax bracket as often as possible. So let's take a look at ways we can help accomplish this. All right, so for most of us, we want to minimize our 2023 tax bill, and most of the techniques we will discuss today center around that. However, there are some years you may want to accelerate income, and there are numerous techniques for that. But definitely talk to your CPA and John or myself before you start buying or selling. Pushing income from year to year can get really tricky, and it helps to have some expert guidance. Now, given all that, let's talk about some ideas for minimizing your tax bill in 2023. Of course, we cannot say with any certainty which one of these ideas will work. It all depends on the variables that are unique to each of you and your family. But these next suggestions are good places to start in managing this year's tax bill. All right, so here's a very easy way to minimize your taxes every year. Fully fund all your qualified retirement accounts every year. So that means fully make full contributions to your 401k, 403b, and or IRAs. Contributing the maximum reduces your income in the year of contribution. So then what's more, the earnings from your qualified retirement accounts are exempt from the net investment income surtax when you eventually start your withdrawals. So you can reduce your income by $30,000 in 2023, and also by $30,000 if you have a spouse by contributing to your employer's sponsored retirement plans, again, such as a 401k, 403b, etc. That's if you're 50 years or older in that case, because you get a catch up there. And while you're working, you have other options such as a simple IRA or possibly a SEP plan. So for example, so long as you have taxable income, you can contribute to an IRA every year until age 73. So this is an easy tax minimization technique that everyone should take advantage of every year, especially if you work at a company that matches your contributions. Okay, the next thing you can do to minimize your tax bill is to increase your allocation to tax-sensitive assets. So what that would mean is that you'd be investing more in municipal bonds, index strategies, exchange-traded funds, and low turnover strategies. So less turnover usually indicates that a fund generated a lower tax burden because it kept its holdings longer, and therefore it didn't recognize large amounts of capital gains or losses over the years, or excuse me, over that year. So of course, there's an old saying that goes, don't let the tax tail wag the investment dog. As in, don't just make investment decisions merely based on taxes. You always want to invest tax efficiently, of course, but taxes shouldn't be the primary driver of your investment strategy. They are only a piece of the puzzle, but it never hurts to invest in assets that pay out in tax-free dollars, with that said. All right, it's likely that you may be sitting on some nice capital gains in your account from over the years. So one way to offset capital gains is to harvest capital losses. Now, losses can be offset with gains, and any additional losses can reduce ordinary income by up to $3,000, with the remainder to be carried forward into future years to then offset future capital gains. So harvesting losses can also lower your exposure to the net investment income tax, or NIIT. Or if you're in a lower bracket this year, you may want to harvest some gains to avoid paying higher taxes in future years. So in recognizing gains or not, one technique is to manage the holdings period. So long-term capital gains are taxed up to 23.8%, while short-term capital gains are taxed up to 40.8%, counting the net investment income tax, which comes in at 3.8%. So by managing your holding periods, you can save up to 17% on your tax bills. Also, loss harvesting is your best bet when you have short-term gains and long-term loss carryovers. And then another technique for minimizing income is to sell securities by what's called stock lots. So investors often purchase shares of stock over time, so some shares might have a higher cost basis than others. HIFO, or HIFO, is a cost basis accounting technique that specifies selling the highest, that's the H, basis securities first. So in other words, you're selling your most expensive shares. So this usually results in a lower gain and therefore a lower modified adjusted gross income and therefore a lower net investment income tax. LIFO, on the other hand, stands for last in, last for the L, last in, first out, and you sell your most recent shares with that method. All right, accounts come in three varieties. You have tax-free, tax-deferred, and taxable. So examples of tax-free accounts are things like Roth IRAs and 529 plans. And then tax-deferred accounts are your qualified retirement plans like 401ks, 403bs, and traditional IRAs. And then lastly, taxable accounts are generally things like your brokerage accounts. Now, you've heard advisors and market commentators talk a lot about asset allocation. But in thinking about taxes, we want to talk about asset location, or where to locate your investments so they get the best tax treatment. So long-term capital gains, for example, are taxed at 20% or potentially 23.8% maximum with a net investment income tax, whereas ordinary income is taxed at 37% max. So naturally, you don't want to turn a 20% tax bill into a 40% tax bill by putting an asset in the wrong account. So after you decide on your asset allocation, look at your accounts to determine where you can locate assets tax efficiently. Some general rules of thumb are to put anything that throws off high taxable income or potential short-term capital gains, things like high yield bond funds, REITs, which are stand for real estate investment trusts, small cap stocks, and also actively managed mutual funds, into a tax-free or a tax-deferred account and an IRA. And then, of course, in your taxable account, you can keep the investments that will be taxed the least, such as things like municipal bonds, dividend stocks with qualified dividends that are only taxed at 15 to 20%. Or you could even include low turnover assets like index funds or exchange traded funds, for instance. Now, the big mistake to avoid here is turning capital gains into ordinary income by placing assets in the wrong account. For example, suppose you purchase a stock you intend to hold for more than a year, and you put that in an IRA, a traditional IRA for that matter. When you do sell, and assuming the stock has appreciated, those gains would then come out of that IRA taxed at ordinary income rates. So instead of being taxed at 20% on a capital gain, since you held it longer than a year, you would then be instead taxed at 37% due to the account that is coming out of. All right, so health savings account are ostensibly set up to help you save pre-tax money, really to cover the medical expenses not covered by insurance. However, they can also act as a sort of shadow IRA, at least as the Wall Street Journal called them. So HSAs enjoy three tax benefits that make them really, a terrific savings vehicle. First, all your contributions are made with pre-tax dollars, and those pre-tax contributions reduce the current year's modified adjusted gross income. And then secondly, all the money you use to pay medical expenses is distributed from the account tax-free. And then thirdly, after age 65, there are no penalties for withdrawing money, even for non-medical use. So what's more, all earnings on your HSA investments grow tax deferred, and at death, the HSA passes on to your beneficiaries tax-free. That's if it goes to a spouse. And if it doesn't go to a spouse, then it would be taxable. Now, the caveat is you have to have high deductible health insurance plan with at least a deductible of $3,850 per individual or $7,750 for a family, and a maximum out-of-pocket cost of up to $7,500 for a single or $15,000 per family. And you will no longer be able to contribute to an HSA once you move into Medicare. But this is really a nice little savings vehicle, both for healthcare and also for retirement. So another way to minimize federal income taxes is to shift or split income with family members. So this has the effect of lowering the overall family tax burden. So for example, you could gift a dividend-paying stock to a child who might be subject to lower taxes. And you can give up to $17,000 to anyone you want to every year. And married couples can actually give double that, or $34,000 to each child. Now, unfortunately, these $17,000 gifts won't reduce your 2023 income, but it could start moving assets out of your estate to save taxes, to really save on taxes later on. And if you move income producing assets to children, the income will be taxed at their rate as long as it doesn't run afoul of the kiddie tax. So shifting income to other family members is easier when you own your own business. In that case, you could consider employing family members, for example, and paying salary to family members reduces the amount of business earnings you must distribute to yourself in salary and dividends. All right, remember earlier when we talked about asset location? Now I want to talk just for a minute about asset allocation. So generally, one of the first things you do in working with a financial advisor is you establish your asset allocation. So what percentage of your overall assets you'll invest in stocks, bonds, and real estate, and so forth. So in time, your winners will grow and your losers will shrink, which changes your asset allocation. So say you started with a 60-40 portfolio, and that would mean 60% of the assets are in stocks and 40% are in bonds. And let's say this is back in 2010. And you haven't rebalanced since then, and now your overall allocation is in a 70-30. Well, you're 10 years older, and keeping 70% of your assets in stocks, maybe at this point just doesn't feel right to you. It might feel a little bit too risky. So the common remedy to this is to rebalance back to 60-40 allocation. And you certainly could do that by buying and selling securities until you hit that goal. But if you're in a taxable account, you really start racking up all sorts of fees and selling charges, and along with capital gains. So instead of selling and recognizing those gains, you could simply add new monies to those allocations you want to beef back up to bring you back to that 60-40 allocation. So you're not reducing your income here, but you're managing the recognition of capital gains. If you don't want to pay tax on those investments in the given year, don't sell them unless you have plenty of loss carry forwards handy. All right, so have you considered who will take care of you as you age, or how your loved ones will pay for your care? Long-term care is expensive, but it's the largest unknown in any financial plan. If you have ever considered securing long-term care insurance coverage, what better time than now? As you get older, premiums rise and underwriting becomes more difficult. So in addition, the premiums may be tax deductible, as you can see in the slide, thereby reducing your taxable income. All right, so trusts are taxed much like individuals, and that they are subject to the net investment income tax, a 20% capital gains rate, and a 37% top tax rate. But the brackets are very different. The top tax rate kicks in at a very low level of $14,450, and this is for last year for 2022. So the question becomes, should the trust keep its earnings and pay the higher tax, or run the brackets, which really just means distribute more to beneficiaries that are potentially in lower tax brackets than the trust? So to answer this question, you really need to run a tax projection for the trust. And as part of this, include a number of qualitative variables, such as, what was the original purpose of the trust? You'd want to double check that. Again, we can't let the tax wag the dog, but if you can distribute $20,000 in investment income to help your child pay at a 20% tax bracket, which would result in $4,000 in taxes, rather than leaving the investment's income in the trust. And then in that case, you'd be paying nearly twice as much in tax. It may make sense to consider alternative options such as that. So now I will turn things over to John, who will touch on the net investment income tax and also on a bunch of other interesting tax-related items. So John, over to you.
Appreciate that, Kevin.
Yep.
And interesting is the key word there. You may not find this of interest, but it is interesting. And I get it. There's a lot of numbers being thrown out. There's a lot of terminology being thrown out. And at the end of the day, if you want to leave this webinar and say, that's why I have you, that's just fine. This is what we're here for. We're here to navigate all of this, but there are a lot of rules and there are a lot of percentages and things to follow. And we just want to be that guide for you in this area. But today's more about just education on some of the numbers. So that's why we kind of get a little geeky when we're going through this topic. So I am apologizing in advance. But as Kevin talked about, we're going to spend some time talking about net investment income tax. And this is a tax that sneaks up on some people. It's an additional tax on investment income. So if you recall, Kevin talked earlier about capital gains and dividends. So that's going to be the tax you pay on a non-retirement investment account, not an IRA, not a 401k, not a 403b, 457. This is for a non-retirement investment account. This comes into play when you meet certain income thresholds that you see here on this slide. Married filing joint tax return, net investment income tax comes in at $250,000 and above. Single filers, it's $200,000 and above. So if you're under those amounts, you don't have to worry about net investment income tax. If you're above it, you do. So on the left are all the things that the net investment income tax could apply to, while on the right are the income sources that would be excluded. You wouldn't have net investment income tax, which again is at 3.8% additional tax. So you've got interest, dividends, capital gains, rental income, non-retirement annuities, passive business activities. All of those things would have net investment income tax applied if your income is high enough. And on the right, different things like employment income, Social Security benefits, retirement plan distributions. You don't have to worry about net investment income tax for those. But just to give you an example of this, So here is hypothetical Ben and Jane file taxes, married filing jointly. So they have an income there, as you see, of $260,000. Their modified adjusted gross income is $280,000. So that means that if you think about that mark I showed you on the screen before, 250,000, they are above that figure by 30 grand, obviously. So right then and there, we know that the non-investment income tax is going to apply to them. And in this scenario, it's going to cover either their investment income, which as you see there is 50,000, or the difference between 250 and their modified adjusted gross income. So 250 to 280 is 30,000. That's lower than 50. So that's the number that the IRS uses to apply net investment income tax. So in this example, 30,000 would have a 3.8% tax attached to it, and you would get to pay $1,140 more in taxes. Thank you very much. Moving on, when we're talking about taxes, not a lot of people really remember. Let's go through the Medicare hospital insurance tax. So this is a 0.9% tax on wages, compensation, self-employment income, and it also kicks in at the $250,000 level if you're married filing joint, and $200,000 for single filers. So that's a pretty common threshold today, is that 250 mark and 200,000 mark for single. And that's when you just have to start dealing with other tax, I won't call them headaches, but we'll call them issues. So looking at the tax I just talked about, this is John and Rachel, who make $330,000 in their combined income. So that's 80,000 more than 250. And then that 80,000 will be taxed at that 0.09% number. So they would pay an additional $720 of tax in that scenario. So let's go into some fun things that can reduce our taxes, like deductions and exemptions. We all love deductions and we all love exemptions. I look for them every day. I look for them far and wide because they reduce the amount of money we're paying to the IRS. And for those that have met with me a lot, I like to say I'm all about paying taxes to Uncle Sam. I just don't want to leave them a tip. So we want to lower our tax bill as much as we can through deductions. And to look at that, here you have two things: the standard deduction and itemized deduction. So there's really, you get to choose every single year whether you take the standard or itemized. And the standard deduction, as you see there on the right for married filing joint, is $27,700. For single, it's $13,850. And that just means that no matter what your deductions are, everybody gets at least that to deduct off their taxes. Now, on the flip side, the itemized deduction says if you can add up more deductions than those numbers, the IRS is going to give you the benefit of using that to deduct off your taxes. So the itemized deductions are certainly nice to have every year, but a majority of our country do not get to itemize their taxes anymore because they don't have deductions that are more than $27,700 or that are more than $13,850 for single. So what can you use for itemized deductions? There's a lot of different things like mortgage interest, property tax, charitable contributions, state and local tax. But the IRS has kind of capped some of those numbers that you can use for itemized deductions. For instance, a big thing they capped was state and local tax. It's called the SALT limitation. You can now only itemize up to $10,000, where before in the tax law, you had an unlimited amount. You could go well above that 10,000. In addition, they capped the deduction on interest one pays for their mortgage to the first $750,000 of your mortgage. And that usually is people don't have mortgages higher than that, but for wealthy individuals that do, they don't get to itemize a $2 million mortgage anymore because it caps out at 750. So on top of that, they took away deductions for home equity lines of credit and tax preparation fees. So that's where I said 90% of our population will only take the standard deduction that you see on this screen because it's pretty big in the first place, and their itemized taxes don't get more than that. So if you look at how they have modified deductions with the new current tax law, you can deduct charitable contributions of cash up to 60% of your adjusted gross income. That number used to be 50%. So if you're really giving a lot of money to charity, a little bit more of a benefit there. I mentioned just a second ago, the deduction of the home equity loan interest is suspended. So a lot less home equity loans are taken out now because of that. A lot of people used to do it for the tax deduction, and they talked themselves into then buying something nice because they said it's a tax deduction. Alimony payments can no longer be deducted, so that is not allowed anymore, and moving expense deductions were eliminated. So personal exemptions were also eliminated. This was an amount that each taxpayer could deduct for themselves and each of their dependents on their tax return. So back in 2017, the personal exemption amount was $4,050 for all filers. But on the plus side, they increased the child tax credit, which is now $2,000 compared to what it was in 2017, which was $1,000. So in my meetings, we talk a lot about all of this sunsetting. A lot of what we're talking about here is temporary. Starting in the year 2026, everything reverts back to what we had back in 2017. So tax brackets change, standard deductions change, rules on itemized deduction change. So we're going to have to do this discussion all over again in a few short years. But this is the tax system that we live and breathe now, at least until 2025 when it all ends, and 2026 is a brand new tax year, and we look forward to having many tax discussions then. This was something called the P's limitation. It was eliminated until 2025, so we don't talk too much about it now. But this was an old tax law which would reduce someone's ability to itemize deductions by putting a cap on them if their income was over certain levels. And you can see what those levels are. Married filing jointly about $313,000, single filers $261,000. And the calculations came to a reduction of about 3% of the amount which your AGI exceeded those income levels I just mentioned. So the Tax Cuts and Jobs Act is eliminating all of this, like I said, in a few short years. And it goes back into play. But for now, we will continue talking about today's tax law. So what I've realized is almost everyone has a special situation that could affect their taxes. And if you check any of the boxes on this list, there's probably a tax saving strategy you could take advantage of that we could talk about individually. So things like, are you thinking about selling stocks that have sizable gains or losses? Are you expecting to receive a raise or bonus? Are you financially supporting a family member? Are you reaching required minimum distribution age 73? Have you made an IRA contribution? So all of those things are just things that we will help you walk through as we do reviews. But that's the important reason why we do like to sit down every year with individuals, because there's constantly rules that that will apply to you based on that particular tax year, and other years it won't apply to you. But a lot of times you don't know what you don't know in terms of what you could or could not take advantage of. So that's what we try and walk you through different checklists like this. So our goal is to just help you put it all together here. Discuss strategies that can help improve your tax situation, not necessarily pay the least amount of tax this calendar year, but pay the least amount of tax in aggregate. I mean, accountants will always talk about what you can do to pay the least amount of tax in 2023, but our goal would be to pay the least amount of tax over the next 20, 30, 40 years. And we're thinking about the train you're on. We're thinking about how these future tax laws will affect you, how all the change in tax brackets is going to affect you, how they will force out money from employer plans and force taxation upon you, how that affects your situation. And we're bringing that all into today and say, how do we use today's tax rules to benefit you over the long run, not just this year? And that's where we just like to work with a CPA. They're a very important part of the team, but we do differ from them in the sense that it's not necessarily our goal to pay the least amount of tax this year. It's in aggregate. That's our job as financial planners. And these wealth summits is just really conversations we have with accountants. We have a lot of different conversations with accountants of our clients, for our clients that desire that, where we're just trying to talk through the tax situation, because we can't file your taxes. We can't represent you in that area, but we want to work with the different professionals that you have and reviewing all the different strategies that sometime we are educating accountants on, which sometimes makes me chuckle, but that's okay. This is a mid-year tax checklist that everybody should review that will affect your taxes. And for anyone that wants this slide deck, just email us after. We're happy to send this out. But things like, is your marital status changing? Did you buy or sell a rental or a home? Are you retiring this year? Are you over that $250,000 mark for whatever reason, which brings in the net investment income tax and other different situations that will affect you as different things that you see on your screen come up. So that's just something that we're on the lookout as we have these conversations, these updates, these review meetings, to see if there's any tax benefits that you can take advantage of because of any of those. And that has taken us to the end. It is 4:45 on the dot. That's the way we roll here. This is just some fun disclosures. I'm sure you've read those all by now. So I'm going to stop sharing. Appreciate your attention. Look forward to talking with you all soon. And I'm now going to